Okay, yesterday we went through a brief overview of what's going to be covered on the 2017 content for each medium of trading. And I want you to go into this weekend, before you go into the videos on Friday night. I know some of you are going to be like Christmas. You're going to go in there and dig into it. Do this exercise first, because if you don't listen to me and you jump ahead and you didn't pay attention to this teaching today, it's a homework assignment. It's very important that you do this, because if you don't do this, you will not get the intended delivery of the aha moment that's waiting for you in the two teachings this weekend. If we understand that there are major players in the marketplace, if they're going to be players in the currency markets, if they're going to be players in the stock market, the commodity market, futures, indices, all that, there's going to be telltale signs that they are at play. They're engaging the marketplace. And I want you to start looking for those telltale signs on a macro level, because once you understand this on a macro level, it is easy to transpose that idea down into the lower time frames. The problem you're seeing with your trading and your inconsistency is you're trying to look for the fingerprints on the lower time frames. And it's going to be very hard to see that unless it's time specific. The element of smart money, they leave their fingerprints on the higher time frame charts, because they're like elephants. They leave big prodding footsteps wherever they go, and you can't escape it on these higher time frame charts. So in your notepad today, I want you to write at the top of your page that smart money leaves their fingerprint on higher time frame charts, and it's up to you to focus on that, because they're telling you the direction of what they're doing with their money. So if smart money's buying aggressively or showing signs of buying, they don't buy for short-term little movements in the marketplace. They buy with the expectation of intermediate-term price moves. Now, intermediate-term price moves are longer than one day. They're longer than a week. They are months, several weeks to several months in duration. So if we're looking at higher time frame charts, it's at our advantage to think like the smart money players do. They are not moving size and positions that are enormous in the marketplace for short-term fluctuations. They can't efficiently move in and out of the markets that way. So when we are looking at lower time frame intraday charts, it takes a great deal of understanding of what's going on in these higher time frames, which will give you the confidence for the daily bias that some of you are still concerned about. It'll give you the direction that you should be primarily looking for. Even though there's trades on intraday charts on both sides of the marketplace, the folks that beat up the idea that you should not have a bias, okay, is they hang their hat on the fact that they've been lucky in the past being able to short in a bullish market. And while I've readily admitted that sometimes it has happened, even in my own trading, I've been profitable doing that, my maturity as a trader has led me to believing that the ideal solution to all the things that all traders should eventually come into contact with adversities and pitfalls is simply understand what these higher time frame charts are telling us and what direction we should be trading in. So I'm going to give you an example of what you should be going through your charts. I'm going to give you ideas, okay? I want you to kind of like dig into the material yourself. You only got until tomorrow evening, and you're going to have both of the teaching sessions. But I want you to be thinking about it. I want you to go into your charts and spend some time today and tomorrow and not look for trades. Don't look for trades, because right now, if you're looking for trades, if you're chomping at the bit, when are we going to look at the charts again? When are we going to go over the markets right now? If you do that, it's not going to be a good idea this time of day. This time of year still has a great deal of uncertainty. Right now, every January, they call it a January effect. If you look at what typically takes place at the beginning of every year, there's usually a big sentiment idea built in. Either there's an extreme on bullishness or it's an extreme on bearishness. It can move into January, end of February. That time period can lag a little bit, but generally around the first of the year, it usually sets the tone for an opposite effect. Okay, and this is not an idea that was unique to me. I learned this actually from listening to one of Larry Williams. He did a real short kind of like he was like a keynote speaker. He wasn't even the major draw, but he did a short little discussion on the fact that in the beginning of the year, January tends to create a extreme, like a sentiment idea that would be a contrarian play. In other words, for instance, I'll give you an example. If you're looking at the stock market right now, equities are, well, they're going to be hitting 20,000. It's making new highs. It's doing everything that every bull dreams of. But it's doing it at the beginning of the year, and it's doing it at a time when we're getting a new president in office, and a whole lot of backroom deals are going on as one supposedly leaves the office and one's coming in. So all these ideas tend to create an extreme in sentiment. So usually that's signs of capitulation. That means that it's probably near a blow-off type move. I personally believe the next drive up in equities is probably going to top this thing, and we're probably going to see it start coming down. Now, I don't mean that it's going to be an end of stock trading, but I do suspect we're going to have a very dramatic decline. Let's say it like that. You can label that crash. You can label that Armageddon, whatever you want to call it. I just personally believe that we're going to probably see that this month, and it's probably going to bleed into a number of months for 2017. So if we see that there is evidence in the past, and you can go back forever as long as you can get market data, there is a element to the beginning of the year generally setting up a really good time to trade where you have a sentiment extreme in the form of, if it's overly bullish going into the beginning of the year, generally we have a very sizable retracement or correction, and sometimes an altogether reversal. And in moments where there's markets that have been making moves lower and we're in primary downtrends, usually at the beginning of the year, there's usually a really significant bounce or altogether a reversal, looking to see higher prices. Now, it's not limited to the stock market. It's the element of this teaching today is I want you to think about the fact that not just the stock market alone, but all asset classes have a connection. Equities are, in fact, connected to currencies. Commodities are connected to currencies. The bond market's connected to everything. All the interest rate markets are connected. The effects of one country's interest rate market has another effect on other countries. A lot of people don't realize that, but the U.S. bond market has a great deal to do with the European bond market. Okay, there's telltale signs that if there's smart money entities out there, they don't just think, well, I'm only going to patriotize my own currency. I'm only going to invest in my own equity market. I'm only going to invest in my own interest rate market. I'm only going to invest in this. I'm only going to be one-sided about the way I do things. Smart money is just like everyone else. They're greedy. They want to make money. So they're going to put their money in allocations that have the best odds of having a return. That's why you have international investors. People that are outside of our country, they invest in stocks that are strong U.S. equities. They think about it. China, they invested in our debt. Not so much now, but they were once the largest holder of our debt. So if you look at the grand scheme of things, you have to start there. And it will be able to be reduced down to a lower time frame on any and all asset classes that will give you the context of what you should be doing in your own trading. If you want high odds trading, if you want high probability trading, it has to come in the form of what the smart money is doing. You cannot arrive at that looking at 15-minute time frames. You can't even arrive at it in an hourly chart. The only thing you're seeing is the confirmations or indications that the higher time frame levels and direction that they have already started positioning themselves in. That's the only time we take action. We've already seen evidence that they have positioned themselves on a higher time frame basis on one side of the marketplace. Then and only then do the lower time frames matter. That's it. That's a big point right there. If you haven't made that notation in your notepad, again, listen. The lower time frames are only significant, and these levels are only significant when they are in alignment with the higher time frame monthly, weekly, and daily. If you do not see any characteristics in the higher time frame charts that would suggest to you that smart money's at play on one side of the marketplace, in other words, are they buying? Are they accumulating positions Because if they are, then and only then do bullish order blocks, do ideas of looking for sell-stop runs, okay, or pulling back into a fair value range to closing a gap or retracement for a bullish optimal trade entry. All these types of things, then and only then do they matter. If you don't think about the higher time frame charts like this, you are going to miss every single explosive move. It's going to evade you every single time, because you're going to be looking at these lower time frames thinking that that's where the money's at, and it's not. I'm trying to tell you that this month, this is the money shot. You're looking for where these things occur, how to get ready for them, prepare for them. It's in this whole entire month here, because without this month, nothing has any context whatsoever. When I talk about day trading, you'll blow it. You'll lose money. As soon as you start trading live funds, you're going to lose money if you don't use the information that's in this month. I'm guaranteeing it. I'm promising you, you will lose your money if you do not apply what's being taught to you in January. So don't think that, okay, I learned what I learned in January. We covered everything in January, so I'm going to forget about that. Just give me the next video, Michael. Give me the next teaching, because I'm going to trade with that stuff. It all hinges on what you're learning here. All right, so we have a major market from an institutional vantage point. That's what we're focusing on today. Now, in the first slide that we talked about yesterday and what's just on the screen now, I mentioned chart layouts and tools. So what are they? What are we going to be doing to ferret out an institutional vantage point? When I say institutional vantage point, I'm teaching you this month how all large institutional players view the marketplace. They don't look at Fibonacci. They don't look at crossovers of moving averages. They don't do any of those types of things, okay? They look at the data points that I'm going to give you in January. It's not a ton of things. It's absolutely very binary. It's simple stuff. It's very, very simple. But it's going to require you to think, and it's going to require you to study. It's not going to be simply open up a chart, look for a down candle, and I'm going to buy if it touches that. No, it's not going to be that easy, folks. It's just not that easy. You need to be looking at things to judge whether or not, if there are characteristic and telltale signs that smart money entities are in fact engaging the marketplace on the buy side or the sell side. Because when you see these elements that's going to be taught to you in January, there's going to be a very strong odds that you'll be able to determine what side of the open float the market's going to reach for. And now, what is open float? Here's a notepad moment, okay? Open float is the existing open interest above or below current market action. So if we are trading at a level and we see signs that they are accumulating or looking to be a buyer, they're buying up a specific asset class, we know that the open float is going to make a run on the buy side. In other words, above the highs most recently that's been made. So that buy side liquidity above the marketplace, okay, for those that are short, they're going to make a run on that side of that market. And if we've been trading at a particular level currently, and we see signs that they are distributing, okay, there's evidences that they're heavily distributing a specific asset class. When we see that, we will have now a strong indication that they're going to be looking for the sell side liquidity. So the open float, they're going to target the sell side of the marketplace. Now, if you can do the work on these time frames and sit on your hands and stop in such a rush to get into these intraday charts and start trading, okay, I'm telling you, a lot of the things that you're worrying about and the things that you're impatient about, they will be answered with this content. But it takes, number one, trust that what I'm teaching you is the stuff that matters. Once you start seeing it and you go into the charts, you'll know there's a lot of time that you should not be doing anything at all if you're going to be only trading in high probability setups. Now, is there less probability setups that still can be taken with less risk just to be engaging in the marketplace? Yes, there are. But my question has always been, why are you worrying about those setups when it's just so much easier to wait for the things that get in line that allow you the high probability setups with the lowest amount of risk? That's what you should be aiming for. Think about it. Smart money's not in there every single day piling money in. They're doing more scaling in and scaling out than they do anything of new positions. There isn't that many new positions occurring on a higher time frame chart because the elephant has to work in that higher time frame realm. They cannot facilitate their trades in short-term fluctuations. So if we know that we're going to have institutional sponsorship behind the moves, that means they're not going to move a little bit. They're going to move a great deal. They're going to have a lot more magnitude. They're going to move more in pips. They're going to have more time to allow you to get in sync with that move. That's the importance of having this higher time frame perspective. And it starts by having a view at the monthly chart. I don't care what asset class you're going to be talking about in your own trading. You may be here with the expectation that, yeah, you're going to learn how to trade Forex. But you're going to probably learn at the end of this teaching, entire mentorship, you're going to be, you know what, I'm probably going to be a commodity trader, or I'm going to be a bond trader, or I'm going to trade the indices. I understand that now. It makes perfect sense to me what's going on. Don't let me, anytime during this mentorship, teach you to think about any one being better than the other, because it's the same stuff. The same thing that smart money does when they accumulate or distribute. It's the same thing in all asset classes. There's small, subtle nuances that go into specific asset classes, like, for instance, currencies. They have certain things that you have to be aware of, and bonds have certain things you have to be aware of. Stocks, they have opens and closes. The sessions end, and you have to restart, and they can create gaps in the stock price. All these little subtle nuances are covered, but everything generally is the same. So if we start with a macro view with a monthly chart, you're going to be able to pull out a lot of information that you don't think of right now. And I'll ask you a question rhetorically. I'm not asking you to respond in the live session, but rhetorically, I'm asking you this. How many times in the last 10 trades, whether it be demo or live, have you consulted what the monthly chart is telling you? How many times have you consulted the weekly chart? Chances are probably very little of you. Those two time frames right there is exactly where all of the large funds are indicating what side of the marketplace they're working, and you'll know where their stops are. And if you know where their stops are, you know where the central bank is going to make their runs against that, because that's the only liquidity they can work with. Think about it. They can't work with us in a retail realm. We're not even in the same playing field. But everyone teaches it's them against us, when it's really not them against us. It's the banks against the large players. That's the real game. We're spectators in that, and we can be a part of it from a side bet standpoint. So if we're looking at these higher time frame charts, we're looking for clues and evidences that there are major movements by these smart money players. Then and only then do we refine these ideas into a daily time frame. So the daily chart is going to give us the executable levels that we should be looking for our entries on. That means if you're a day trader, those levels are on your daily chart. If you're a scalper, they're on your daily chart. If you are a swing trader, those position levels for execution and entry are on your daily chart. You're looking for that all to occur on a 5-minute chart, 1-minute chart, 30-minute chart, an hourly chart. They can be used to refine and reduce risk, but the general setup isn't that. It's found on the daily chart. Everything you're looking for is on that daily time frame, because the banks are referring to that. Daily highs and lows, interweek highs and lows, last week's high and low, monthly high and low, the last 3 months high and low. What's the 6-month high and low? The last 12 months high and low. Then you go into multi-year highs and lows. All those levels are going to be what the institutions worry about getting new positions on or off. The funds, because they are predominantly trend following in nature, they're going to be looking for ways to get in sync with a long-term up move or long-term down move. They do not have an interest in trading in consolidated range markets. So now, what does that indicate? Think about this now. This is a notepad moment, folks. If you're off in a distance or doing laundry right now, you need to be paying attention, because this is important. If we know that there are elements to smart money getting involved, what telltale signs will we see that gets us into an idea that they're bullish or bearish? Well, you learn it by going over your charts for at least a year. You got to have at least a full year's worth of data on your daily chart. If you look at your daily chart over a full 12-month period, I want you to dissect that full year of delivery of data on a daily chart in 3 to 4 month increments. Now, it's up to you to do this. And I cycle back and forth when I do this type of analysis, as you'll see in the teachings this weekend. The 12-month intervals, obviously you can have 4 3 months or 3 4 months. It doesn't work exactly like every 3 months it goes up and makes a high, and every 3 months it goes down, it makes a low. It doesn't work like that, folks. It does not do that at all. But if you divide what has happened over the last 3 months or the last 4 months, so it's a range of 3 to 4 months, and you do that over the whole calendar year. If you do this, number one, you're going to divide the marketplace, okay, in study points and reference points. And I want you to do this as homework. I'm going to actually give you homework in the next slide that tells you what I'm wanting you to do. So that way we can compare notes when I'm delivering the content in the 2 teaching sessions. You see if you saw these types of things that I'm talking about in the teachings. But you want to look at price, and what are you looking at? Okay, well, think about it like this. Look at the dollar index as one. Okay, or it could be the stock market. Okay, you can. It could be anything in particular. It doesn't have to be an indice. It could be a specific currency. It could be a specific stock. It doesn't have to be. And just think about this as a broad brush idea, because it's a macro institutional vantage point. It's the same thing, no matter what you're trading. If it's tradable and you can make money on it and you can speculate on it, it's the same process. Market makers do not do different things because it's a different asset class. It's the same model, absolutely the same model. So it comes by way of the central bank. The central bank makes the rules for all this stuff. That's why they want to put their hands in everybody else's country, because they pulled strings. So they call the shots on how it's done. And if you look at every 3 to 4 months intervals over the calendar year of 12 months on a daily chart, divide your chart up with vertical lines, okay? You're going to have every 3 months, there's going to be a vertical line, and then print out another copy of that chart. Literally print it out. Don't have it on your screen. Print it out. And do one where you have every 4 months. Okay, so you'll have 3 divisions for every 4 months, and then you'll have 4 divisions for 3-month intervals. Okay, and what you're going to be looking for is signs and evidences that there's smart money at work. Now, when you see an accumulation where the market stops making lower lows, okay, and then starts moving higher, yes, it's a hindsight exercise. You cannot learn this going forward. You have to see what it looks like to see the fingerprint. It's the same as anything else that's ever been taught to you. You have to see what the outcome or the output should look like. Otherwise, you don't know if you're getting the result you're supposed to be getting. So by studying the marketplace over the last 12 months, in any asset class, it doesn't matter what it is, you're looking for signs that when the market has in fact made a turn, in this case we're using the example of accumulation, if the market stops making lower lows and then starts moving higher, at that low, there's going to be fingerprints and like evidences that low was forming. You may not have been trading it. You may not have even been aware of it. You may have actually had a trade that you didn't see that occur, and maybe you ended up having a losing trade. That's not the point of this. The point is, I need you to go into these higher time frame charts to look for these signs, okay, that show you that they are in the move and transitioning into another price swing that's going to last several months. When you're looking at the lows in an asset class, for instance, and we're going to talk about stocks for a moment, because it's the easiest one to teach this concept with. If you think about how I teach stock trading, I only teach the highest probability time of trading is the fall. Between September and November, in that time frame, the market's going to make a low. I don't care what year you trade, it's going to do it. Now, I didn't personally trade this past fall because my personal belief was there's going to be a great deal of uncertainty. And while I missed a good deal of moves, I'm okay with it. I'm not considering, beating myself up about it. I stuck to my convictions and didn't want to do majority of the trading I would normally do. But I shared on the YouTube channel some of the stocks that would have been ferreted out using that system and that method, it in fact pulled you right to the very ones that smart money was buying. The accumulation pattern, okay, and this is what you want to write down in your notes, the accumulation pattern by smart money is failing to make lower lows. When you're comparing that with correlated asset pairs or asset markets, and I'll give you an example, and then we're going to use the stock market as an example. And I'm going to tell you how to use this going into your homework so that way you know exactly what you're going to be doing. But for the stock market, let's just say we're looking at the Dow Jones Industrial. Now, some of you are saying, I don't want to hear about this, Michael. I'm only interested in Bitcoin and currencies. Again, it's the same stuff. Just apply it to whatever asset class you're going to specialize in. But for discussion purposes, say we're only looking at the Dow Jones Industrial. Okay, so that's an indice that measures the collective and cumulative average of the movement higher or lower on specific 30 stocks. Big blue chip companies, these stocks make money. They're really in business. They make money. They're used every single day by other companies or people almost on a daily basis. So they are real profiting companies. They do commerce. They're real entities that mean something. They're not penny stocks. So if we're looking at the Dow Jones Industrial and we have an expectation that there may be some buying in the Dow Jones Industrial Average at a level that we suspect there should be support coming into the marketplace. If we go into the individual 30 stocks that make up the indice, when we start seeing a number of those stocks failing to make lower lows, what is that indicating? Is it indicating that they just didn't get enough sellers? No. The smart money accumulation pattern is at a time when the expectation is bullish, markets that fail to make lower lows, they fail to make a lower low because of the demand behind it. They have to be bought at a higher price. Think about it. What's in high demand right now? Is it a 1987 Camaro or the 2017 Phantom? Of course, it's going to be the new car. They're the ones that everybody wants to drive. That's where everyone wants it. So the value isn't going to decline when there's more demand for it. It's going to be kept at a premium. So they're going to be buying. And the fact that the price fails to make a lower low, that is professional accumulation. That is a sign that smart money is accumulating that. So if you start seeing a number of stocks in those Dow 30 stocks failing to make a lower low at a time when you think that the Dow Jones should be going higher, it is. Because you actually have evidence that the individual stocks are being bought by smart money. They're not making lower lows. And that's what creates that divergence pattern. That same thing's applied with the macro indice. You have the Dow Jones Industrial, the NASDAQ Composite, and you have the S&P 500. If you are seeing these three composite index making lower lows, but one of them fails to make that lower low, again, that's that hallmark symbol of smart money accumulation. It's telling you that somebody, a collective group of large entities that have a lot more money than us are coming into the marketplace and they're buying. So if they're not letting the indices work together and make lower lows, that means somebody's buying something. And then you got to go in and start doing some more research. What are they buying? What are the stocks that are failing to make lower lows? That same thing now can be applied in reverse. Now, when you look at the market in terms of, again, we're going to use the stock market as an example. The Dow Jones Industrial Average is making higher highs, but it hits a level you anticipate seeing as resistance. It's seasonally time for the stock market to decline around July going into August. Usually that's a real good time to be a seller in the equity market. That time of year, if it hits a resistance level, go into the individual Dow 30 stocks and look at the ones that are failing to make lower highs. Failing to make a higher high. So you're going to have lower highs where other stocks that have been leadership issues, they're making higher highs to make that Dow Jones Industrial go up. But the weaker stocks that fail to make higher highs, they're indicating that they are the ones that are being distributed. If you can see that happen in existing downtrending markets, you have a loaded deal for a perfect shorting opportunity because you're selling short in an already pre-existing weak market or weak stock. And they're showing you that they're distributing it heavily. How can you use this information in a currency market? Well, if you're looking at the dollar index, what we do is we go through the marketplace in the same way over the course of a full year. We're going to break down a daily chart in quadrants or in thirds, every 3 months or every 4 months. And we're looking for these quarterly shifts that take place. The dollar index makes a significant intermediate term high, and it starts to trade lower for several months. Then it makes a short-term, intermediate term low, not short-term, intermediate term low, and then it starts to trade higher. Okay? What we're looking for is every 3 to 4 months, there's a significant intermediate term price swing. That intermediate term price swing occurs on the daily chart off of levels that are arrived at on the weekly and the monthly chart. So you're looking at levels, order blocks, stop runs on monthly and weekly levels, and transposing those ideas onto a daily time frame. But then you're breaking down your daily chart into thirds every 3 to 4 months, and then you're going to look for what that has done in the past. And here's another exercise. Don't just use this last 12 months. Go back as much as your personal time will allow you, and you'll see that there are major significant turning points in the marketplace at these intervals. Now, I know some of you are saying, there's somebody in here that are rather still cynical. Well, that's all great, Michael. That's too broad brush. It's too vague. Okay? We haven't completed the teaching yet. I'm getting you thinking like an institutional perspective. You have to have these ideas on a macro level to condense it down to a smaller time frame for high probability, low risk. But for dollar index trading, okay, or currency trading, what we do is we go into the dollar index and we look at our monthly levels. We look at our monthly, are we at a premium or are we at a discount on a monthly level or at a monthly chart? Where are we in terms of the current range? Are we really suppressed and low? Well, chances are, if we see a resistance level, does it have a great deal of probability on a daily chart? Maybe not. Could, but probably not. Same thing occurs with a weekly chart. If we are in the last bit of significant movement lower in the weekly charts, been trading lower, and then we see a weekly level that would be indicated as resistance, okay, does that have high probability over a potential weekly support level? Because think about it, we're now at a real deep discount on the monthly and on the weekly chart, as an example. So what would that indicate for a daily time frame? Probabilities are really high that if we see some indication that they're buying or they have some buying come in, failing to make a lower low in the dollar while the foreign currencies, the euro and cable, make higher highs, suddenly what does that indicate? Now you have a fingerprint that you have a discount on the monthly chart. You've been trading lower. You're at a level where there should be support. And the weekly chart, it's been trading lower, so we're now at a discount as well on the weekly chart. And even though if the weekly chart looks like it's hitting some kind of a resistance level, does that mean it's a sell? No, because you're already low on the discount to premium range. So if you're in discount, that means price is oversold, basically. So say it like that. We don't use indicators to determine overbought and oversold, but in terms of the range where we've traded on these time frames, the higher time frame, if it's really been trading lower, and just because we're at a resistance level on a monthly or a weekly time frame does not mean that that's a good selling point for a daily or any other time frame. It means to me, I start going in there and looking for justifications for them to be accumulating. And I look for signs that they're accumulating around a specific level that we arrived at a monthly and a weekly chart. And I transpose those levels onto a daily time frame. Then I wait. I'm waiting for that element that they have entered the marketplace. What is that? That's displacement. The market will suddenly create a big boom that'll rocket up. You may anticipate it coming. You don't have to see it coming. You just wait for it to occur. When it does, you now go right back into where it just recently rallied from, the bullish order block, the last down candle. And when that comes back down into that bullish candle on the daily time frame, you now have the most significant entry point for low risk, high probability, and it's a loaded deal because the monthly and the weekly are at discount. You've already seen the market show an unwillingness to respect that supposed higher time frame resistance level because it's now shown it wants to go higher. And then when it trades back down to that same level where they moved away from, the impulse price swing, that idea is that you now know that they have bought. Everyone else is going to see that as a selling opportunity because the monthly and the weekly are in downtrends. It does not equate to that. No, it doesn't mean that. It means that you're looking for the next move on the daily chart for this new third or fourth quadrant that's over time. You're going to divide your chart into 3 to 4 month intervals. And all we're trying to do is look for the next 3 months out. Essentially, that's all we're doing. We're trying to anticipate and forecast where the highest probable direction is going to be over the next 3 to 4 months. You don't need every bit of that range to be moving in your direction. You don't. It's not the intended purpose. Now think about it. If we divide our range in the form of every 3 to 4 months, that means we have about a month and a half or 2 months of potential one-sided price action. If everything worked in cyclical fashion, it goes up and it goes down. Well, how long did that whole interval take place? If it takes a month to do it, the halfway point would be 2 weeks. Well, if we're looking for a shift in the marketplace to go higher, and we're expecting some accumulation to come into the marketplace, and that means they're buying, that means the dollar index is, in this case, we're looking at the dollar, say the dollar index fails to make a lower low when all the foreign currencies make higher highs. That's that smart money technique that we use, the SMT divergence. If that occurs at a time when the monthly and the weekly are at discount levels, and it blows through what would be seen as some measure of resistance, okay, on a higher time frame level, and you're probably asking, how can it be trading at a resistance level, Michael, if it's at a discount? Because if it broke down below a previous low, what does support and resistance teach us? That broken support is now resistance. I love trading those ideas because I think that is the biggest losing setup, because everybody thinks these long-term trends are all straight lines, and they're not. So if we can buy at a time when the marketplace is going below an old low on the monthly and weekly, it's going to trade back up to that old low. But if it's been trading for a while, we're going to be really suppressed in a discount condition. And the market can trade a lot on a daily time frame and still maintain its bearishness. We've already taught many times before, it goes not just right to the bottom of the low, like support, broken turns, resistance ideas teach us. Sometimes they go through that level a little bit and they reach in there deep, and then it could still end up rolling over and continuing lower. But in a daily time frame, that could be hundreds of pips or hundreds of points in an indice. It could be a lot of range that could capture big money. So if we're looking at these movements every 3 to 4 months, what we're really identifying is, I want to know where the next 3 to 4 weeks movement is, because it's a half-life of that cycle. If we're looking at 4 months as our horizon, half of that's 2 months. Well, if we're looking at 3-month intervals, okay, it's half of that. So ideally, I'm looking at, in a perfect world, I'm looking at a horizon that's 3 weeks to 4 weeks long. That's what I'm looking at. That's my time horizon. Now, I try to do my best to see what I think may occur over the next 6 months, but I don't have consistency in that I can hang my hat on and say, yeah, I know without a doubt it's going to do this or that. I don't believe I have that, and I don't believe anybody can have that. But if someone does it and they write a book or a course, I'll be glad to share that they've done it. But up till now, I have not seen the evidence that support that idea. But it's really easy to forecast about a month's worth of price action. And look at a monthly chart of anything. There's lots of opportunity in that range, tons of opportunity, regardless of what type of trader you are. So if we're going to apply these ideas, okay, commodities, let's look at that. If you're going to be a commodity trader, okay, and you think that the market has moved into a realm where the commodity market should be going lower, the CRB index is going to be going up. It's been trending higher. If it hits some level of expected resistance, we are at a premium in price. Everything is overvalued or overbought without the use of an indicator. But you're going to go in and start looking for evidences that are commodities really being distributed? Are we topping out? The way you find that out is you go in and start looking at the individual commodity markets. And you'll start seeing that inside of, like, for instance, the grain markets will start failing to make higher highs. And the ones that fail to make higher highs, they're ones that you want to be selling short on. If the commodity market as a whole is going to start going lower, you want to be selling the weak of all of those industry groups or commodity groups. You have the agriculturals, which are the livestock and grains. Then you have the financials, which are debt instruments, currencies, oils, and metals. And you classify them, break them down individually by group. And you can end up ferreting out, when we teach commodities, I'll tell you about all this stuff in specific fashion, but you can go in and find all of the weakest individual commodities to be going short when the CRB indicates that we're going to be going lower on commodities as a whole. It's the same thing done with the Dow Jones Industrial Average for those 30 stocks, just applied to commodities. Now, I saw a question on Twitter, and I just remembered this as I was talking. A gentleman in our group was looking for, well, you said CRB is opposite to the dollar index, but there are times when, because commodities are the world's grocery store, they're going to have, and I'm going to say this now, they have real supply and demand factors behind them. If you're on an island, and I said, here, look, I'm going to give you a bar of gold or an ounce of wheat, which one are you going to take? If you're stranded on an island with no hope of getting off of there, no time soon, what are you going to take? You want the wheat. I don't care who you are. You can't eat gold. You're going to want that wheat. So wheat is never going to zero. Gold could. And if you believe in the Bible, it's going to be worthless eventually. But the point is, grocery store of the world is the commodity market. So if we understand that that is a real supply and demand market, there's going to be a little bit of a lag sometimes with the commodity market. And that's the only caveat that comes with, in my opinion, with trading commodities. So you have to allow a little bit of a time element to it, where if you see the dollar indicating that it's bullish or bearish, that may not be immediately to the very day, whereas if you use it with another currency, it's immediate. Like when the dollar's going up, that should be immediately reflected with the euro going down. Those things are in tandem with one another. They're lockstep they're diametrically opposed, basically. But when you're referring to commodity markets, they have real supply and demand factors that are involved, and those will always create some measure of time delay. So don't think, just because the dollar index is surging up, and you can go back to the chart and say, well, look at the commodity CRB index. It was going up too from November. Yes, it did. But that doesn't equate to or it doesn't diminish the truth that over time, a strong dollar will suppress commodities, because it is. That's the way it is. But certain commodities do have their own unique characteristics on supply and demand that will contribute to the CRB index, not initially right away moving in tandem with the dollar index, but diametrically opposed to it. The same element, when we look at institutional vantage point with the interest rate markets, and this is what I've taught so far, either in the free tutorials and now in the mentorship, is when we look at the interest rate markets, we're comparing the relationships of the 30-year, the 10-year, and the 5-year. And if we're expecting a turning point to occur, we're looking for that failure swing or divergence between the 30-year, 10-year, and 5-year. For instance, if they've been moving up in concert with one another, and all of a sudden they fail to make a higher high together, okay, that's going to indicate something for us as a trader as it relates to the dollar index. Now, if it means something to the dollar index and the interest rate market's telling us something too, that's also going to give us clues about the other foreign currencies, and it's also going to give us clues about the commodity markets as well. Oil market, gold market, silver market, all those markets are closely related. But it takes the one at the bottom of the list, even though it's listed last here, it's the most significant one. Basically, I say the best for last. The interest rate market, if you understand this, it will give you every macro directional bias that you need to be trading in for every 3 to 4 months. If you look at the divergence that's seen in plotting the yield on the 30-year 10-year, and 5-year notes. And you can do this on investing.com, and you can do it on Bloomberg as well. They're free, and you don't need to have it real time. You don't need that. Okay. The best signals will occur with end of day data. You don't need to have it intraday. Now, if you want to have that as part of your day trading, we use that later on in mentorship, and you'll see how to get that information and do it live. But for now, end of day data is all that you need. You don't need anything else apart from that. Everything that you see on a daily chart, once you see the daily chart populate on yours and you start a new day, that data is already in there. You can't do anything with it but reflect on it. That's all that's necessary for an institutional vantage point. When the traders sit down and they're working out what they want to be doing and how they want to be scaling in positions, they're looking at these 3 time frames, the monthly, the weekly, and the daily. So let's get into the nuts and bolts of what I'm asking you to do. Here's your homework. I want you to pull up any currency pair, any asset class, any asset class. It could be a stock. It could be the bond market. It could be the oil market. It could be gold. It could be live cattle. It could be oats if you're a grain trader for commodities. I don't care what you're talking about as a trader in the future, what you want to be focusing on, specializing in. Whatever that is, I want you to pull up a chart, it's a daily chart, and look at the last 12 months data. And I want you to break that 12 months down into 2 charts. Print out one that's dividing it in every 3 months, and I want you to print out one that divides it in every 4 months. And I want you to circle the high that's formed or the low that's formed at every one of those intervals. Now, you may see that it creates a high or low right at a 3-month marker, but don't demand that. Expect every 3 to 4 months there's going to be a cycle shift higher and lower, okay? Even if the market's not trending, it will create a high and it'll create a low, back and forth. It's the ebb and flow on these higher time frame intervals, monthly, weekly, and daily. But you're going to be looking on a daily chart the last 12 months action. I want you to pick one before you go into the study and stick with that one as your first point of reference and study. And then I want you to pick a second one at random and do the same thing. And then for a third one, okay, I want you to go into the marketplace. And if you're looking at currencies, you want to look at a currency that has this real strong trend. For instance, like right now, there's really not a strong trend in euro and pound. There's other currencies that I'm not going to say in here because it'll kill the study for you. There's other currencies that have a trend right now. I want you to look at that and contrast that with those that maybe you've selected that don't have a trend. Maybe it's been in a rather large consolidation like the pound and the euro has been for several months now. If we know that the smart money, this is a big notepad moment for you, if we know that the smart money is accumulating or distributing in these higher time frame charts, their expectation is long-term. So again, they're looking for moves that's going to transpire over months of time, not intraday action. If we know that this is occurring in a market that's already trending, now here's $1 million tip for you guys. If you see these elements or telltale signs and fingerprints that they're accumulating in a pre-existing bullish market, you have a mega trade at your hands. That means that that market's going to go astronomically well beyond what you think. It's going to go beyond your Fibonacci extensions. It's going to go beyond all the things that you think it's going to go to. Okay, it's going to go well beyond that. The same thing said if you're looking at a market that's been trending lower. If you're looking at a market that's been trending lower and you're seeing signs that the marketplace is indicating that smart money is distributing that, you have a loaded deal for a mega trade for a short. That means this thing's going to go a lot lower, way lower than everybody's expecting. And it's going to overshoot every objective you're probably going to come up with. And they're really fun markets to be in. But what you're going to be doing is you're going to note any significant divergence among markets or asset classes that are closely correlated. Now, again, what that means is a perfect study would be the Dow 30 stocks. It only takes, literally takes you 20 minutes to go through the entire list of the Dow 30 stocks. And it'll teach you that fingerprint. And I did basically pull out the ones in the stock market for this year. If you go into the last month's teaching, you'll actually see the recording. I think it's on the 11th. if I'm not mistaken. The 11th or the 9th, I did that that presentation. You can see the stock leaders for 2016. And you'll see the stocks that led the up move in the Dow 30. You can do this same study with the currency markets, okay? And you'll arrive at, if you just go through the majors real quick, you'll see which ones have been trending strong. And when you get this SMT divergence where the dollar index fails to make a lower low, when the other foreign currencies make a higher high, what is that telling you? It's telling you that the dollar is being accumulated. It's being accumulated. It's being bought up because it can't make that lower low. If the dollar can't make that lower low, it's telling you that the dollar wants to go higher, and it doesn't want to go lower. So that means all the new higher high in those euro and pound dollar charts, they're all runs on stops. And they're selling it to everyone at a premium and then wait for that thing to start correcting and going lower. The same thing is seen with the commodity market. If you're going to be looking at commodities, use the CRB index and then look for the commodities that fail to make that equal high or equal low at every 3 to 4 months. But you start by looking at it just as a conceptual idea. At every 3 to 4 months, there's a major shift. I don't care what asset class or what you're trading, every 3 to 4 months, there's a significant move. Now, if you go into those individual moves and you break it down and you study that whole transition, you'll see that there is a divergence that takes place with closely correlated assets with that same interval in time. For instance, I'll give you another example. If you see that the metal market, okay, you have gold, silver, palladium, copper, and platinum. Two of those metals are relatively thin. They don't have a whole lot of trading going on. But you look at times when the commodity market is expected to go higher. If you look at that, okay, and I'll give you an example. In November, the CRB index, 2016 CRB index went higher. If you go into the individual metal markets, compare the lows across those several metals I listed. You have gold, silver, high-grade copper, palladium, and platinum. Look at the price action there, and you can't use this for your study. I'm just giving you one as an example, okay? And you'll see the professional accumulation that took place, and then you'll see the result of what happened and what metal led on the upside. Now, it doesn't require a great deal of study. You don't need to turn this into a PhD or a thesis, okay? It's literally going to take you probably a half an hour to do this homework. But I want you to reflect on it when you see that and you see the failure swings to fail to make new highs as the asset class moves higher. You want to be looking for closely correlated ideas and other things like the stock market example we just showed or the commodity example I just gave you regarding the metals. If you're going to be doing currencies, you're going to be looking at it in relationship to the dollar. So if you're seeing the currency markets that you're focusing on as your pair, like for instance, if you pick the euro, if the euro is making that higher high, okay, is that failure swing in the dollar making no attempt at a lower low there? Did that occur at that major turning point over the last 3 to 4 months? Did it occur? Did that occur? And what you're going to see is it's there. And some of you are probably saying, yeah, I know this, Michael. I already know this. No, you don't know it yet because you're the same people that are asking me in email, you really didn't teach this good enough for me here, or I feel a little bit unsure about this. You're not looking at it in the charts. And once you see it and you study it, you don't need a large sample size of it. It's there. It's a classic accumulation and distribution pattern that is evidenced in price action. That's why I tell everyone since 2010 when I stepped out here and told everybody, there's nothing that's going to change about this. By me teaching it, it's not going to change it. It's not going to diffuse it. It's not going to water it down. It's just going to just get better over time because the more efficient we get with delivering price to us, and now I think it's as efficient as it's ever going to be because now we have access to information at our fingertips just like that. I mean, we're carrying around what used to be in a warehouse-sized computer. We have it in the palm of our hand with a smartphone. We can do so many things with this thing. But the failure swings you're looking for, and again, I'm not trying to create confusion or whatever. It's the same thing that we do with the SMT divergence with the dollar. Okay, so if we're going to keep things germane to the currency markets, just over the last 3 to 4 months, okay, look back in every significant intermediate term high or low in the currency pair that you like to be trading or you want to specialize in, and compare that with the dollar index. Did it create a failure swing? If it made a higher high in its price action, did the dollar fail to make a lower low? Or did the dollar index make a lower low, and did your currency pair, while it was moving higher, fail to make a higher high? That's the same thing, just being explained in a different context. For instance, if the dollar index makes that lower low, but the euro fails to make a higher high, what is that indicating? It's indicating that the euro could not be sold at a higher price. It's being heavily distributed. So if the euro is being heavily distributed, is that bullish or bearish for dollar? Bullish. But does that equate to a buy on dollar? Not necessarily. The dollar could consolidate, or the euro can consolidate. So what does that mean for you as a trader? Go back to that reference point I told you to write in your notepad. What's $1 million maker? Is your currency that you're looking at already in an existing trend? Because if it's not in an existing trend, that's when the consolidation can occur. Just because it's diverging in an S&T divergence where the dollar fails to make a significant high in relationship to a lower low in your currency pair that you're studying, like euro dollar, if that's the case and you're in a trend, for instance, if we're bullish, if the euro was in a bullish trend on a monthly, weekly, and daily, we expect higher prices. Okay, it's been trending higher. And the dollar, okay, fails to make a higher high when the euro makes a lower low. That's still a buy on euro. All they did was went down below an old low, take up the sell stops, and accumulate that long position, and then you'll see euro dollar rally. The same thing could be said this way. At the same time, if the monthly, weekly, and daily for euro is in a bullish market, okay, and you find that the euro fails to make a lower low while the dollar makes a higher high, that's the same thing. That's a big time buy signal for euro dollar. So you have to have these things understood conceptually. It's not just, I'm looking for a divergence and I'm going to go short because it did that. No, what does it mean? Because if the market itself that you're seeing and studying is in a rather large consolidation, it doesn't equate to an explosive move all the time. It may have to take time to eventually move up and gradually. And by then, you probably lost your mind in frustration waiting for it to move. The same thing is said, obviously, looking for failure swings when you're looking for lower lows are the asset class that's directly or inversely related to supporting that idea. And again, for the dollar index, everything's going to be inverted. Everything else, you're looking at comparatively the same lows and highs. For instance, the dollar, and the equity markets, you're looking at the individual stock prices as they make higher highs. Is your indice, is the Dow Jones making higher highs? If that's not happening, then you're probably seeing underlying weakness, and eventually you're going to probably see some measure of retracement or an altogether reversal. But you're looking for it to happen every 3 to 4 months. Now, some of you, admittedly, and I already know if I go into the comment section for questions, some of you are going to be unsure about what it is I'm asking you to do. And some of you already know what I'm asking you to do, okay? I'm using this as a basis to gauge where you're at in your understanding of my information so far. Because that way, it'll tell me how much more I have to include between now and Friday night in the teachings that I already have put together. If you have no understanding about what it is I'm asking you, don't be discouraged because you're actually going to see me do it in this weekend's teachings. So tomorrow night when you turn the videos on, you'll actually see me actually do the very thing I'm explaining to you here, okay? The point is I want to inspire you to go looking for it now because in summary and in closing, while I'm telling you this, we're getting ready to close the session. When I discovered that the thing I was looking for was on these higher time frame charts, and when this quarterly shift takes place, these macro trend reversals, okay, those things are gold mines because once you understand what's actually happening, you don't have to be so precision oriented with your entries, and you don't have to be on time. You can be a little late, and that's what I needed because I was doing a job that required me 13 hours a day to do it, and that was 45 minutes commute time added to it. So I had very little free time. So when I discovered that the bond market created these types of things, it made it so much easier for me to be prepared for the next day. What am I going to be doing next week? Well, it's the same thing. I'm going to be looking to be going short because where we're at right now, and I was looking at the chart, the market had been moving higher in the bond market. The market moved up into a high. It moved into a level of resistance for me. I'm anticipating the bond market going lower. Now, am I selling just because it went to that resistance level? No. And this is the answer to some of your questions. How do you know if the resistance level is going to hold? That's what this gives you. It gives you that answer. Because just because you have a level where the market is supposedly a resistance point or a support level, unless you see evidences that that is a support level by doing this homework here, this study, if it doesn't have classic telltale signs of accumulation and distribution by smart money studies and by having an institutional vantage point, in other words, let's say it this way in plain terms, the stock market's not going to go lower in a correction or a reversal unless you have a number of issues failing to make higher highs. It's that simple. It just doesn't happen. Oh well, it's going to crash today, and every stock in the index made higher highs. It never does that. It never, ever, ever. That's absolution. It never happens that way. The way these major turns every 3 to 4 months occur is there is a gradual easing in by that elephant. They have to work their position in. Otherwise, you would have that element of everything goes up and they make equal highs and then it crashes. They can't move into the market that efficiently. They have to gradually work it in. And by doing that, it keeps these underlying issues or currencies from making higher highs when they're trying to sell it. And then everything's obvious after the fact and say, oh, well, there it is. Look, it wasn't going up when everything else was. It's going to be seen easily in hindsight. And that's the point of the exercise. I want you to see what it looks like. And it's not something that just happens once in a while. It's not a willy-nilly pattern where, well, it happens once in a while, like support and resistance. Well, it happens here or there, and this trend line worked here and there. No, that's ambiguous to me. That's ambiguous. The thing that remains constant is the smart money accumulation pattern is you'll see not just one asset class showing you there's signs that this thing wants to go up. Other asset classes are going to support that idea too. So in summary, go into your charts, look for a daily chart every 3 to 4 months. There's going to be an intermediate term high or low forming. Inside that intermediate term high or low, I want you to look at everything that is closely correlated that you understand up to this point now. Maybe you know things that I haven't taught yet. Use that information too. But everything that has been taught to you from the mentorship and in the free tutorials and anything I've ever heard, well, you heard rather, me say and teach about the concept of price action, apply it to what you understand and see if you don't see what I'm explaining to you here. Every 3 to 4 months, there's a major market shift. By having that understood, we will be able to know that we have another leg in price on a higher time frame macro level that we can get positioned for. And we wait for these things to form. And you sit on your hands and you wait. And when it happens to get to these levels and you start seeing evidences that it's supporting smart money accumulation at levels where we think that bullishness should be there, then and only then do we wait for that displacement to occur. When we see that happen on a daily chart or a 4-hour chart, that gives us the green light to go in and now find where the order blocks are, the bullish order blocks, and when price hits that on a 15-minute time frame, that's when you execute. That's when you load the boat. That's when you back up the truck and fill it all the way up, man, because it's going to go up. When you see it and you start studying it, you're going to want to go back a year later. And you're going to want to go back a year later. And then when you do that, you'll be quickly convinced that this is not a random thing. It's something that's cyclical. It happens every 3 to 4 months. It happens every single year. Every asset class has it. It doesn't matter what type of trader you're going to be. This is information you need to know. And if you don't know, if you don't really understand what I'm asking you to do, and you're one of the newer students here, don't be discouraged. Just be a little bit patient. And, well, let's be a little bit patient and say it like that. And wait till tomorrow night when I give you the 2 teachings, and you'll have all weekend long to go through it, and it'll explain to you in great detail and minute detail of what it is you're looking for and how to use it. And trust me, you will be very excited this weekend when you see what's in these 2 teachings, because it gives you a great deal of clarity about what it is that we wait for why I say patience is important and what it is that you're looking to see occur in your charts. After this, you won't need to look at anything with monthly, weekly, and daily anymore for teaching purposes. Everything in these two teachings here will set the tone for everything you'll need to know that completes the January content, but you'll know everything you need to know about higher time frame analysis. You'll know how to do top-down analysis. You'll know how to do everything in terms of prognostication and forecasting. You'll know what it is you're waiting for, and by knowing that, it removes emotions, it removes the tendency to rush, and it gives that whole clarity aspect that everyone wants and sometimes pretends online they have, but they don't have any idea what they're doing or what they're looking for. This gives that to you. It gives you the confidence that you don't have to be trading every single day. And if you want to go away with your family and take a vacation, a specific month or year, you can do it because you know the same thing's going to happen again. And all you got to do is find out where you are in that range. The beautiful thing is you may end up looking at your charts this weekend and see that we have created something just recently. Now, I don't know because I haven't done the analysis. I'm going to be doing my own analysis for the first time when I sit down with these today. I'm doing the recording for the first teaching today, and I'm going to be doing Friday's, going to have the second teaching done. That way everything will be online to you at 8 o'clock, Friday night, New York time. But you're going to probably discover that the importance is even if you don't get the actual turning point and get positioned there, you can still get in sync with that move because you're trading on a higher time frame chart. And it gives you a whole lot of opportunity to get in sync with that move. And you don't need the high or the low to be in to make the money on the move. So I'm going to close it here. I encourage you to go into what you understand so far right now. And again, if you don't fully understand it, that's an opportunity for you to learn more. Trust me, this is how it works. You learn by muddling through what little information you have, and then the aha moments happen. You may get close to it in your own study, and then when you see it, I saw that. I saw that in my own charts. When you see me explain it to you, I'm going to be using the currencies, and I'm going to use the stock market. And when you see me do it, you'll know right away what it is I'm waiting for every 3 to 4 months. You're going to know even if you ended the mentorship at the end of January. If you do, you're full. But if you did, you would know exactly what I'm doing every 3 to 4 months, what I'm waiting for, what I'm waiting to see, and it repeats every freaking 3 to 4 months. There's no skip in it. There's no lag. None of that exists. It's absolutely there because I know that every 3 to 4 months, the institutions have to shake things up, and they put money at work at different places. And if you understand that elephant, it's big, but it's slow. It has to gradually move into the marketplace. It has no other way around doing it that way because they can't efficiently get their positions on. And by doing that, it creates this big, slow turning point. And you'll see evidences that other correlated pairs, other asset classes that are closely correlated to it, they're going to support the idea that that's a resistance level because they're failing to make higher highs or lower lows in relationship to it. So I'm going to close it here. Wish you good luck and good trading. Have a pleasant day.